Welcome to the Ken McElroy Show. I'm your host, Danille, here with Ken.
What's up? How are you guys?
Whew, we have had a long weekend
Oh, my gosh.
of Limitless.
Yeah. For those of you who came to Limitless, thank you.
Yes.
Hopefully you really enjoyed. If you did, make sure you hit like because, man, we had 1,700 people there, 40 speakers. I was busy.
Yeah.
I was running around like crazy and some really good questions from a lot of really very successful people.
It was really fun to meet all of our viewers too and kind of put some of your faces to the your YouTube handle and really see, who's all watching our show. That was really fun.
Yeah, I got a lot of really good ideas. We met a bunch of really fun folks there, and we did a bunch of podcasts. That was fun.
Yeah, that picture of you and Tarl.
Yeah, here's me and Robert and Chris Martinson, and that was a great talk. And Joseph Wang from the Fed.
Yeah.
That was awesome. There's my interview with Chris Voss, Never Split the Difference. So good stuff, guys, and appreciate you guys who supported it this year. We've heard nothing but great things about it, and for the most part, that was Purnacha, CEO of Deepak Chopra organization. So good stuff.
Yeah, we had a good time at Limitless. We had a good, nice party.
Yeah.
Couple nights.
Man, I'm wiped out, guys. I got to tell you, I was so fun. There's so much great energy in that room, and so many good questions, and there's people slaying it all around the country.
I know, it was really cool, and I met a lot of women that were killing it in the real estate game too. I know, ladies, there's not that many of us, so it's really fun to see it when you see some people that are. Michael wants to know, is there a recording of the Limitless event on YouTube?
Yeah, there will be. It'll be at limitlessexpo.com. I don't know exactly. Obviously, we just finished, so I know there's some editing and some things that have to happen, but then it'll definitely be available there.
Awesome. Well, today, we were pretty busy last week, so we're a little late to the game here, but the Fed has paused rates, and that is the big news right now that everyone is talking about.
Well, what was cool is it was Wednesday. I think they met and they decided they were going to pause. I think a lot of people were hoping for cuts. I don't think that's coming, guys. One of my talks was there's a part of the Fed called the dot plot, DOT, and what the dot plot does is it predicts there's 18 people on the Fed Open Market Committee, and it predicts where they're going to vote on the next rate increase and where they think rates are going to be in 1 year. So if you type in Fed dot plot, you'll find it. And what it actually shows is that in 18 months from now, that they don't think rates are going to go down all that much. In fact, in the next two meetings, they think they're going to go up a quarter point each. And Fed Powell even said that, Chairman Powell.
Yep, they didn't say they for sure were going to do that, but he said that was a possibility and that they were going to weigh their options. So before you jump into that, I want to just go over a few things. So inflation is down year over year. We're down to 4% now. It only increased the 0.1% from month to month. And core inflation is still high. So inflation is doing well, but core inflation is still high. Core inflation doesn't count food or energy prices. And a lot of this core inflation is coming from the shelter costs are driving this.
Well, shelter costs were 8.7%. Mm-hmm. So that's what I did in my presentation is that the reason why I think that they're going to continue to raise interest rates is because shelter costs are 8.7 as of May. And shelter represents 44% of the CPI. So shelter costs are almost double inflation, or more than double. And so that's why I think that we're going to see a couple small rate increases in the next few months.
Do you see shelter costs going down, though? Because we have heard that rents are slightly going down, especially on the West Coast. Is that what you're seeing? And do you think that those prices will go down?
I think everybody's holding on to those things, but let's take a look at where. Like why are they going down in downtown Portland or downtown Seattle or downtown LA or downtown San Francisco? Has very little to do with inflationary issues. Has to do with crime, has to do with safety, and has to do with a lot of people moving. If you take a look at rents nationwide, they're down, but they're not down. They're down from last couple of years' aggressive increases. So rents are still growing right now. So, and I think the real issue is home prices are down in most markets, but as they increase the interest rates, their mortgage payments are going up. So rents are there. Let's say, how do I want to say this? Rents are definitely increasing, but not at the rate that they were. So when people say, you got to be careful when you say rents are down, they're not actually. We're not seeing concessions in a lot of these markets. We are seeing it in some. And I think that the Fed is kind of watching this. The problem with housing is that there's not enough.
Right. So
as people fall out of single family, it puts pressure on rents.
Well, let's get to that. So right now, the single family, because the reason I wanted to address shelter cost is because the Fed is trying to increase rates in order to lower inflation. And as shelter is one of the big factors in inflation, the question is hiring rates going to help that? But the problem is these 7% mortgage rates are handcuffing current homeowners.
Well, that's a different issue, but
it's not
a
different issue because it all ties in, because then there's no supply and it's going to make buying more expensive than renting.
So how does that handcuff the homeowner? I mean, how does a homeowner, what does that matter when it comes to rent?
It doesn't, but the 7% mortgage rates are handcuffing the homeowners, which are making it so they're not listing. Since they're not listing, the prices of single families are staying high. And because the prices of single families are staying high, people are renting, which are keeping the rents elevated.
Right. That's what I just said.
Right. Yeah, so that's how it has to do with it.
Yeah, no, it's exactly right. The rents that's why we're going to continue to see rent growth. And that's what my presentation last week was about at Limitless, was that people group single family and multifamily into one big category, but it's not. When there's a problem in single family, people can't afford it. They move to rentals, and it puts pressure on rentals, and not in a good way if they're trying to fight inflation. Rents are going to go up. We're heading to a renter nation right now.
Yeah, and these home prices are a big deal. So, in 2020, when you could get a 3% mortgage, a $300,000 mortgage was about $1,200 a month. And now at 7%, it's about $2,000 a month. So it's a big difference. So people aren't trying to upgrade their homes. Like a lot of people are. What I'm seeing too is that a lot of these homeowners on the houses that I follow aren't able to sell maybe for the price that they want because people can't afford that 7% rate. But because they're at 3%, they're just renting out their house. So I was looking at 2 houses this morning that I've been following, and both of them are off the market now, and I guarantee they're going to rent them.
Well, if you have a 3% mortgage, that's an asset, period. The loan is an asset. For the first time, as long as I can remember, cash, because of inflation, is a liability, and fixed rate debt is an asset. So if you have a 3% loan and you have a lot of equity in a home, 2 things are happening. One, you're saying, why would I sell that? To your point earlier, you won't, because even a lateral move means you pay $1,000 more a month, and so you're going to stay put. And or if you do, you're not going to sell that home. You're going to rent it, like you just said, because the mortgage is low and it probably cash flows for you. So in a lot of ways, it's probably creating some landlords that never thought that they would be landlords because they have, again, this 3% loan, which is an asset.
Right. And they might not want to be landlords, but right now they're just not able to sell their places for what they want to sell them for, what they need to sell them for.
Well, I mean, you and I are looking for a house right now. We're looking at building one. We're looking at buying one. And my mortgage, I have a very small mortgage. It's 2.8.
Right.
Like, I'm not going to, why would why would I get rid of that?
Right.
It's significantly below inflation. You're borrowing below inflation.
Yeah. Yeah. It's really good. And, June had the least amount of new listings on record. So really, people that are waiting for that single family home crash, it depends on if it's going to happen on inventory and then how high they push the rates up, right? Because eventually if they push them high enough, I mean, it would crash the market, but I don't know if they're going to push them that high. And right now, home prices are only down 1.6% overall. But we do have more units coming to market since the 70s. So this is the most units we do have coming to market that are being under construction right now.
Yeah, we also have more people. So, a lot more. So it's not apples to apples in a lot of ways. But I think, what's happening right now is if you were building something a year ago, you're trying to sell them as quickly as possible. So there's all these stats that say that, the new home construction is really selling quickly. Yeah, of course it is. That's because they're buying down the rates and getting people in there. Even if it's for 1 year, they'll buy down. And they're moving inventory that was already under construction. But generally, people aren't starting new builds right now.
Right. There's not a lot of new construction going on. Most of it is, what was started in 2020, 2021, and they're kind of finishing it.
That's because rates were low then.
Right.
So if you're a builder, you have the same issue as a homeowner.
Mm-hmm.
Your rate of construction cost and your construction loans are also doubled.
Well, and it's interesting because we have a long way to go. Right now, it's cheaper to rent than to buy. And so because of that, we're having more renters and less buyers. But what's interesting is rates need to get all the way down in the 4s for it to be an even playing field in most cities between renting and buying, which we could be a long way of rents being down in the 4s.
Rents or mortgages?
I'm sorry, mortgages.
Yeah. So mortgages, guys, we're a long way from there. If you take a look, the dot plot says by the end of the year, they think that rates are going to be about 5.5, 5.6 on the federal funds rate, by the way. And then there's a spread on top of that. So, you're looking at 6 and 7% rate, even potentially higher. Even the lines of credit are what, 8, 10, 12%?
Yeah, they're between 8 and 10 is what I'm seeing.
Yeah, that's a line of credit. So all that's pushed up. So the cost of money's gone up. And that's the point of the Fed. And the reason they're doing it is precisely because shelter costs are still high.
But it is interesting because I was watching George Gammon's channel a couple of days ago, and the Fed, per him, the Fed has never paused and then raised rates in a time of recession. Ever.
Yes. Yeah, but they haven't called a recession yet.
Correct.
Yeah, so that's the thing. A recession is 2 consecutive quarters of negative GDP, and last quarter we were 1.2 or 1.3 percent. So we're not there. They haven't actually officially called a recession.
Right. It is going to be interesting, though. It really is a 50-50 split on people that think they're going to raise rates. July is going to be interesting, right? Because, they're calling for the 0.25% increase.
They are.
And it'll be interesting. Do you know when they meet exactly?
I can't remember exactly. We can put it up on the screen for you guys. But they, they just met, 4 days ago, 5 days ago. Mm-hmm. And so it's sometime mid to late July, if I remember. But the real, I think what everybody's trying to determine is everybody wants there to be cuts.
Yeah, and actually Robert mentioned that on here. He said, so much for a cut, but a pause makes me think higher for longer is real now.
Exactly right. I agree with him. Guys, there's a lot of, I don't know about you guys, but are you really seeing prices come down? I mean, we're seeing oil come down, or I'm sorry, gas prices, but Chris Martenson at Limitless showed why. if you take a look at the oil reserves, we have this is already just like you guys would have reserves of cash against property. We had oil reserves, and you take a look, and he said this is the first U.S. president that's ever basically depleting the U.S. oil reserves. And so I asked him the question, why are they depleting that? He said, well, to prop up to keep the per gallon price low. So he's doing it for political reasons. Whether it's true or not, don't know. But what you can do, fact check, is that under the Biden administration, there's been a significant decrease in oil reserves, and they've been using the oil reserves. That's what is the right way to say it. And also they cut off the Keystone Pipeline, which is another thing that we used to use to keep those high. So why is that important? It's important because oil is a big piece of almost everything we do. You need low price per gallon to transport food and supplies and materials and things like that on ships and across the country and all that stuff, and then almost everything we have and own is is petroleum based. So it's going to be very, very interesting to see what happens.
Yeah, absolutely. And just so everyone knows that's watching, I am under Ken's account today. So when I type and it's Ken, it's actually me. I left my laptop at the gym, So anyways.
Normal day for me.
They have it. So, but Adam said, prices have been nuts at the grocery store. It amazes me how everyone is acting like nothing is happening. It makes me wonder how many people are food insecure right now.
Yeah, it's a problem, guys. Like, it's the other issue that's they've been dancing around is wage growth. So they're at 3.7% unemployment. Now, why is that important? It's important because low unemployment drives wages up. So the Fed actually said they're concerned about it. Actually, the Fed chairman out of New York said, we believe that we need unemployment at 5%. Mm-hmm. So if there's 162 million workers in the United States, 1% is 1.6 million people. So that could potentially mean, and they've said that they need actually higher unemployment. So this is coming at a horrible time, is that they actually are going to probably drive that higher, because the lower it is, the higher wages get pushed up, which is inflationary. So if a year ago you're paying somebody $20 an hour, maybe it's $25 an hour. Okay, the Fed's watching those things, and they're saying that's not good. So part of wage growth is, I guess I think for the longest time as an employer, I think we were doing like 3% increases.
For a long time
annually.
Mm-hmm.
Okay, well that was above inflation, and but now it's not. It's all over the map. So the Fed's concerned about that as well. So that's, I think, one of the bigger problems heading our way.
And over here they said that the Fed meets again. I believe it was July 25th, 26th.
Okay.
So, but do you think that the Fed really will induce a recession? Do you think they'll really do it?
I have no idea. I'm not that smart. All I know is I'm just following what they're saying. And, what they did say is that they're looking at potentially another quarter point for the next two meetings, and that they're concerned about unemployment being so low. And they actually specifically called out shelter.
Right.
Because shelter's running as of May, it was running 8.7%. 8.7%.
Now, do you think the cities will try? Do you think the government, Fed, and cities will do anything to try to limit rent growth? Or
they already have. Yeah. And that's called rent control. That's called rent cap. There's all kinds of things. What they don't understand is when they impose rent control somewhere, smart money, even anybody listening here is like, well, would you Would you invest in an area where the government capped how much income you could have? And of course, they were beating you up on the other side with property taxes and higher utilities and higher insurance costs and all those kind of stuff? Probably not. So that's why at Limitless we had Clay Akawenzi from Berkadia talking about, as a lender, whether it's debt or equity, they do look at those things. Money goes where it's treated best, and but the cities, I think they're just really out of touch. What they really need to do, what they don't understand, is that we actually are in a housing shortage, and we have been for a long time. And what drives that? What makes a housing shortage worse? Higher interest rates, higher construction costs, and cities that don't want housing.
Right. Well, limitation. It's not they don't want housing. It's they're putting limitations on the profit from the housing, so they get no housing.
Yeah.
Now, do you think? So I talked to these couple guys at Limitless, and they were saying, they own some buildings in California, and they're dealing with the rent control aspect too, right? So, how do you recommend somebody that is in a city that's already dealing with rent control? How are they supposed to make money? And kind of, they're value add guys, and it's hard to value add when you have rent control.
Well, value add is the opposite of rent control. I mean, it's exactly what the city doesn't want. What they want is you not to value add. They want you to keep the existing housing price and stock the way it is, and just fix it and keep the rents low. And the whole point of a value add is to take something and increase the rent on it. So, but I think that there are many ways to be able to operate in an environment like that. And, you got to take a look at what the median household income is in the area and what the rents are at. And then you can operate underneath those. Mm-hmm. So, what they're going to do, it'll eliminate any new construction. Mm-hmm. And it'll force people to, kind of take a look at some of the older stock and then renovate it, rehab it. But they won't have the rent lift. They won't have a value add. That's for sure. The cities that have a rate cap, that's a little different. I think I mentioned, is it St. Paul, Minnesota, or I can't remember exactly. I think it's at 3%. So they're saying the most you can raise rents is 3% as an example. So there's a lot of cities looking at that.
How do you manage in that kind of environment?
Well, that's the point. You don't. Yeah, especially if they and this is not an exaggeration. You can have 20, 30, 40, even 50% raise in property taxes. That's happening right now, by the way. Because these cities, they realize that these people have moved in a lot of places. And their costs are up too. So, think of you as an individual, you have inflation, but a city also has inflation. So they need more income, and how they get that is by raising property taxes. So if you raise property taxes 20% and then you cap the rent by 3%, is that an area you would invest in?
Well, no, but what if you already are invested in it?
Yeah, well, that's what's happening, and that's why a lot of people are going out of California, selling their stuff, moving to places like Texas or maybe a little bit more landlord-friendly,
Yep.
Maybe it's managed a bit better, maybe an area. So people, how many people are paying attention to who their governor and their mayor is right now? A lot, right? Because the political moves are real.
Yeah.
And you got to pay attention to them. And in some respects, you got to, if you put on the other hat, I get it. If you don't understand housing, and on a perfectly simplistic basis, rent control might sound like it would work. Right? Like, let's say if you got elected to office and you don't know anything about it, most of them don't. What they're going to do is they're going to sock it to the landlord, say you can't raise rents anymore because we don't need more homelessness. That's how simple they think. But the reality is that just creates more scarcity in the market. there's more and more people that turn away from that market. You need a free market. The cure for capitalism is, the purpose of capitalism is to drive prices down. Like if I'm building something and you're building something, we're competing against each other. The market does it for you.
Right.
In this particular case, the government's doing it for you.
Right.
And so, people are like, they're moving away. There's not a lot of investment into Oregon as an example.
Right.
Pick on Oregon. Oregon has a statewide rent control. So, it's just not a market that a lot of people are looking at.
Yep.
So what happens if people are moving to Oregon and the money isn't building housing?
Right.
Price of housing goes up because the population growth creates a demand, and the supply stays the same, and therefore prices go up. Prices of rent, prices of housing, and so there has to be an equal balance. You have to take a look at the bigger picture.
Yep.
Can you relax the zoning? Can you make the impact fees less? And, how do you, in a growing economy? The problem is politically nobody can say that. Everybody has to go in with the same old thing. We're going to lower taxes. We're going to, all these things, right? In order to get elected, they say all those things. Nobody's going to say we need to add a bunch of housing, and we need, nobody's going to do that.
Right. Right. Well, I do think it's interesting because the politicians, they don't really understand housing, Democratic or Republican, most of the time. They just have different views of the people they counsel on what to do with the housing situation. But it's definitely getting out of control no matter how you look at it, right? I want to address, a couple things first. If you're watching this, please hit the like button. It really helps us out. Would like to get to 150 likes on here. And then secondly is I have a webinar coming up on Friday. It's mistakes that you don't want to make when buying your first house or rental property. So whether this is a home for you to live in or a home for you to rent, it's free. Just go to kenmcrory.com/webinar. Steve's going to put it in the show notes over there. Really good advice in there. So Florraine wanted to know, and I think this is a very good question because I do think people listening have this issue. So he or she is a limited partner in a multifamily property. The general partners have already called for capital funding. How do they decide whether to hold or try to sell the multifamily property? So a little background is when you're a limited partner, the general partner's the head of the deal, and they kind of decide what they want to do. And so she's just wanting to know how do they make that decision?
Sure. It's a very, very good question. So here's how it works. The irony is that most multifamily is performing. So that's the irony here. Rents are still growing, although modestly they're growing. Expenses are also up too, but generally people, from what I hear, are all kind of hitting their numbers. What's happening is the debt is up. Mm-hmm. Okay, so I'm going to answer the question, but you have to take a look at all of those things. So first you have to look at the income, then you have to look at the expenses, and then you have to look at the debt. And you have to look at all three because that's going to determine, do you hold, do you refinance, if you can even, or do you sell? And in most cases, multifamily properties have been repriced down because the interest rates have gone up. So think about it. Let's say you invested in that same property today. The offer would be less because the cost of the mortgage is more. So the mortgage payment is more and the cash flow is less, even though it's the same property. So, rents have not changed that much in 1 year, let's say. So your net operating income or your NOI probably hasn't changed that much in 1 year. Maybe a little bit if you've got some kind of value add going on. But at the end of the day, what's really changed is the mortgage payment. Mm-hmm. So your cash flow's down. So the fact that they did a cash call tells me that they're probably in it for a little bit longer haul because it depends on what the letter said and how they're using it,
Right.
But it's not unusual for there to be cash calls right now based on these higher costs of debt.
So should they be worried about this, or should they just know this is just kind of part of the atmosphere right now?
Well, first of all, you can worry, but there's not a thing you can do. I mean, as a limited partner, you're kind of, that's why it's the word limited. The general partner kind of gets to decide the direction of the asset. Now, you do have a voice, so don't get me wrong. But at the same token, there's no reason to be worried. If they're out of money and they don't have any cash, and they're going into some kind of foreclosure, and the property management around all of it is bad, and there's been some properties and some companies in the news. Remember that big group out of Texas? I think it was Arbor, ARBOR, went down as a result of, some poor operations and poor ownership and higher cost of debt. So I don't know what property it is. And a lot of it's going to depend on the operator, the syndicator, the experience that they have. And hopefully they're communicating to you what the short-term and the long-term options are. But if rates keep going up and they don't have fixed rate, then, they're going to need more cash probably. But it just depends, Yeah.
Yeah. They wanted to clarify that the general partners chose an adjustable rate mortgage instead of choosing a fixed mortgage.
Oh, yeah. So there you go. So, yeah. So, I think you guys know we've talked about this. My partner Ross and I, we did some cash out refinances, but we also did cash in refinances.
Yeah, why don't you explain that?
Yeah.
Because everyone's heard of a cash out refi. Those are the fun ones. So what's the cash in refi?
Well, you always buy a property to do a cash out, right? So you increase the value, and then you put a new loan on, and you take cash out. Tax-free, that's kind of the model. That's the Burr model. That's what everybody talks about. On a cash in, you actually write a check and you fix the debt. So when you have a floater or a variable debt, you are subject to the market, like the next two Fed increases as an example, if they even do. So, it's good news that they paused, but who knows what the future holds. So for us, what we did is we did a cash in. So we fixed our debt, Fannie, I think it was Fannie or Freddie, 5.2% fixed. So we were floating, then we fixed, but we had to write a check to fix. So, so what I wanted certainty on my mortgage payment. I wanted to know what my mortgage payment was going to be each month. While we rode this out. I don't know if rates are going up. No one does. But what you've done now is essentially you've hedged the up, so you've fixed it, so you don't have to worry about if they go up. And then you can also take advantage of the opportunity if they go down. And that's kind of the point. So for us, we fixed at 5.2. So we're good. We know what our payment is. And if rates go to 4, we'll refinance. We'll refinance at 4. So that's kind of the point.
So if somebody's in debt that is adjustable and they want to get it to fixed, why wouldn't they be able to do that? Would they not be able to do that because they don't have the cash? Is that part of it?
Yeah. Well, so what would happen is you would take the property and you would go to the lender. And the lender would tell you.
Yeah.
So the debt service coverages are different today. The loan to values are different today. The interest rates are different today. So everything's a little bit different. And then they tell you. They say, this is what the property's worth. And this is the loan that we can give you. And based on today's rate. So for those of you who might not know what a debt service coverage is, or DSC, debt service coverage. It's essentially an insurance policy for extra cash above the mortgage. So let me give you an example. Let's say you have a $1 million net operating income, NOI. Obviously, the loan that they give you, they're going to make sure that your payments aren't $1 million, because then you now have zero cash flow, right? So the lender's looking at the NOI at all times. and they're going to put a debt service coverage on there, which let's say it's like an insurance policy. So let's say it's 1.3. So 1.3 would equate to about a $700,000 a year mortgage payment. Let's say that's 12 months, all 12. So that gives them a 30% buffer, if that makes sense. So your NOI is $1 million. So then they back into all that, and then that determines how much they lend you. So that's a 30% cushion, and that would be distributable cash flow.
Right.
So they always start with that and then back into the loan. And that's how they'll figure out how they'll size the loan. And so then they'll take a look at your existing loan as opposed to that new loan, and that's either a cash in or a cash out.
Okay. So that's very interesting. I know a lot of people right now are having questions on that. We're getting, people emailing you on LinkedIn. We're getting people emailing you on, Instagram and TikTok. So it's good to kind of cover that. Let's jump into our questions of the week. These come from our Inner Circle. In order to join Ken's Inner Circle, go to kensinnercircle.com. That is where you can sign up to be a member. It's about $30 a month. You can ask Ken questions, and we answer all of them either by email or on here. So Luce had a question. They have 8 units, and they can sell now and get about $500,000 after all closing costs. Or the property is cash flowing right now. Should I sell it and save the gain for later when the market tanks, or should I just leave it as it is since it's cash flowing?
So what's the current rate?
I don't know what the current rate is, but they said it's cash flowing.
So that's one of the things I look at is what's the rate. Again, if it's cash flowing at, let's say, 5 or 6% interest rate, then, I might take the cash. But the problem is if you take the cash, what are you going to do with it?
Yep.
So, you really need a home for it. So I don't like to have a lot of liquidity in cash. Personally, I like to have it in some kind of a hard asset. You also are walking away from the cash. It's probably tax-free, would be my guess, based on your depreciation and all that. So you have to look at all of that. I would look at the capital gain that you would have for the sale.
Said $81,000.
That's the capital gain.
Well, that's the tax he's gonna owe. He or she's gonna owe.
Yeah. So, I think I would probably hold if you have fixed rate debt.
Yep. So the next question comes from Kenny. Kenny says, I'm 34 years old and I have a house that I've owned for 10 years and a 3 small unit RV park that I own free and clear.
Nice.
My house is worth about $260 and I owe about $100 on the house and the RV park I own. What question to you is, should I sell my house and RV to end up with around $280,000 in cash so then I can go buy real estate to hold and rent? Or would it be best to just refi the house, keep it for a rental, and pull money out of the RV park to buy more investment property?
Wow. There's a lot going on there. I love it. First of all, you own something free and clear. That's Danille's strike zone. She loves that. She doesn't like that.
Don't.
So we're a little bit different there. I like that. I don't like that right now.
Yeah.
So that would be, as Danille knows, we're not really buying right now because the debt's so high. So I like that at 3% fixed. We've been killing. You're way below inflation. So I'm an accumulator of assets. So I like to hold assets for the long haul. So a lot of people ask, should I exit? Should I exit? Should I exit? My normal answer is no. Yep. Cash flow. Wait till rates go down and then do refinance. If you want cash and if things are, you can always put a line of credit against your mobile home park or your RV park if you want.
But they're so expensive right now.
They
That's
are.
the problem.
I know. I'm just saying. But it would be that way if you sold everything and bought something new. It'd be the same.
Yep.
So, I think you should. Man, I think you're in a really, really, really good position. And the problem is that we don't know which direction things are headed for real estate. But you got everything cash flowing now. Why give up the golden goose?
Yeah, and then get into debt that's high rate interest.
Yeah.
Because you owe $100,000 on your house. It's probably a very low rate. Would be my guess. So Mike is asking from YouTube, are you still pencils down right now?
Yes.
Yep.
Yeah, for all the reasons we've been talking about. I got a lot of flack for that back in December, but now it looks like I made a good decision. There's a lot of people, looking for cash calling. There's, especially in the commercial real estate sector. Guys, this is about ready to hit pretty hard. I don't know if you've really paid attention.
When do you think?
It's already starting. There's people running out of money. There's cash calls happening. It's kind of the beginning of all that. Mm-hmm. And then limited partners decide, do they fund? Do they not fund? The general partner has to make a decision. Are they getting the money? Are they not? If they can, what does it mean? How much does it cost? Are they diluting people? Is it worth the debt? There's a zillion questions going on. So I think that we're still early, personally.
Yep. For those watching, make sure you hit the like button. Really helps us out. Would like to get about 50 more likes on here. Also, don't forget to check out my webinar, Mistakes People Are Making When They're Buying Their First Rental or Their First House. You don't want to be that person. So it's a free webinar. Go to kenmcelroy.com/webinar to check it out.
Yep. I think the mantra is stay alive to 25.
Stay alive till 25.
And, work on your operations and try to build up your cash. Even though you got a 4% inflation rate, just try to build up your cash.
Well, that's what you're doing at MC Companies is you're really fine-tuning your operations right now, right?
That's right. Yeah, we're going through every single line item.
Well, you got kind of busy as you were busy before and you didn't have time to really analyze it, but now you're...
Yep. When you're growing your business, you don't pay a lot of attention, or I shouldn't say a lot, as much attention on all of those fine little things. And that's what...
The expenses,
yeah. We've been doing that. It's been awesome.
And people are asking about Barry Sturlich. Do you know who that is?
Yeah. Yep.
So he needs to sell 2,000 single family homes he owns. Do you know anything about that or not really?
Yeah, I saw that. They've got a big public company. Yeah. I really have a lot of respect for this guy. I think they need cash. So I think they have a lot of office and hotels, if I recall. And so they're selling off some of their their single families. Looked to me like they needed cash. They have more than that, if I remember, but they're selling 2,000. They're going to dump them on the market and try to exit. So, yes, I did see that. I think it's a short-term cash play.
Got it. So Miguel from the Inner Circle wants to know, I have a question regarding depreciation. Being that it is only allowed for 27 and a half years by the IRS, what do you do after that period has ended? Is there any other way of reducing taxes?
Oh my gosh, there's so many ways. And first of all, that's just for residential. You've got other depreciation schedules for commercial and there's a lot of ways. There's bonus depreciation, there's cost segregation, and also there's the 1031 exchange. So, things don't just end, at 27 and a half years. I think that, They've been going after real estate. This has been around for 100 years or something. So I think you're going to be good.
Yep. And Alex is wanting, Steve, can you put the webinar link in the show notes, please? Just so people can sign up. All right. So Mark from the Inner Circle had a question. He said, I own a number of properties that I rent out to a national brand tire and auto retailer. I took 2 of these properties and put some cash in the bank, and I did a cash out refinance in January of 2022. I financed at 4.9%, but that resets in 5 years. I was told this is normal on these type of loans. Is that correct?
Yeah, it can be depending on, who you got it from. So it sounds to me like it is what it is. Well,
a lot of the commercial loans you can only fix for 5 or 7, right?
Yeah, but it sounds to me like you're good to 2027. So, I think you're good. It sounds. By the way, congratulations on getting. People don't realize you can. A lot of times you can get businesses, even in the single family and multifamily side. They're building a big semiconductor plant here in Phoenix, and they're pre-leasing entire apartment buildings, the whole thing. So, some of these businesses are really, 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 really great ways to get some cash,
Yep. And Steve, the webinar link looks like it's not working. So I guess we'll have to have people sign up later. Okay. What was I going to say? Oh, yes. Somebody had asked earlier about insurance rates, and they were really
horrible,
killing people.
Yeah.
So do you have any advice on trying to mitigate those insurance rates?
First of all, if you take a look at the May CPI, the largest percentage, it's in double digits, is insurance.
Mm-hmm.
It's nuts. So, I asked the question, like, why is insurance so high? And people are saying that what they're doing is some of these big disasters that happen like down in the Southeast, they're subsidizing, the rest of their company, the rest of the portfolio. So as an example, I'll just pick on State Farm. Let's say State Farm is a nationwide, actually they're probably worldwide, I don't even know. But point is, big loss in one state, spills over, they penalize people in other states. So that's probably a very simplistic view, but that's what I've been told. It's bad. In fact, pick on Florida again, in the multifamily business, it's not unusual to see insurance at over $2,000 a unit per year. So just to put that in comparison, Texas would be $700, $800. So, Florida insurance rates are more than double. Some areas along the Texas Gulf, same thing. Now, so that's a really astute question, because that's something that's starting to trickle through right now. One of the things to look at potentially is you can self-insure and you can raise your deductibles. So how does that work? So if your deductible is $5,000 or $10,000 or $25,000, as you raise those deductibles, the insurance premium goes down. So and then you can self-insure. So what would that do? Let's say you owned a 10-unit apartment building, and you had a $5,000 deductible. If you raise it to $25,000, your insurance premium should go down. But then what you do is you keep that $25,000 in cash. So you're self-insuring up to that deductible. And what you would not do is you would not turn over these little small claims. Those little small claims are what kill you. So what's a little small claim? A kitchen fire, or a small plumbing leak or water leak or something. So anything in the $5,000 to $10,000 range. So you would use that money to do all those things instead of turning them over to insurance. So a long time ago, you used to turn those over to insurance.
Right.
So it's the same thing. If you get in a lot of car accidents, your insurance rates are going to go up. If you turn over a lot of claims on an apartment building, your insurance is going to go up. So you can self-insure that piece, and that will help, because insurance companies do look at your loss runs, and it's important that you don't turn everything in.
It can be more. I used to work in insurance back in the day, and on a much smaller scale, but people want to turn in like a $3,000 claim, and it's like, well, your insurance is going to go up from this claim, so you have to really look at, is it worth it, or can you just something you could just pay?
A friend of mine owned an insurance company, and I said, how is it you're so profitable and you can have your name on the side of a big building? Fair question.
Right. He
said, well, those insurance claims we pay out every year? I go, yeah. He goes, we just build them into the next year's premiums.
Yep. Exactly. And
so essentially they never really pay claims. They're just, there's a lag. They get it back the following year.
M. Deering said, worry about your limits, not your premiums,
yep.
Which is, And Steven said, insurance for the gym my wife and I run went up 40% from last year.
Yeah.
And you're seeing big increases for single family isn't as bad. Like in Arizona, we have pretty inexpensive insurance, but on multifamily and businesses, some of this stuff can be very expensive.
Yeah, insurance is a big deal. Just type in CPI for May, and you guys will see insurance is it's just out of control right now. This all just jumped up in the last 6 months. Yeah. So everyone's scrambling to try to figure out how to bring them back down. The other thing that's happening is property taxes are just getting killed. Now, if you don't own something, that doesn't really matter. But if you're in a situation like the gym that we just saw, and the landlord that you have gets clobbered with higher property taxes, in the clause of your lease, they can pass that on as you guys know, through their CPI, their annual CPI costs. So I would expect that you guys are going to start to see that come rolling through. So it's nuts what's going on right now. So this inflation is rippling through commercial real estate like crazy.
Everything, really. Hillary from the Inner Circle wants to know, how much cash flow is enough cash flow?
Well, I think it can never be enough. So,
I think she said, like, what's the minimum?
Yeah. Well, I think you have to take a look at what reserves you want. And so, for us, we like to have 6 months operating costs. So, first I would do that. And then from there, just distribute,
Right.
Like, you got to build your reserves to what is comfortable for you. So that might be a maintenance reserve. It could be a insurance reserve, property tax reserve. Sometimes the lenders take those. Sometimes they don't. Sometimes you just want to have a partnership reserve or whatever it is. Just, build those reserves first and then just distribute.
Yeah. And I think on a smaller scale for, a smaller landlord, you at least want $300 or $400 a month. I mean, because if you're going to have 300, you're probably going to be breaking even. Because that's really just one thing that goes wrong a year.
1 week of vacancy.
Yeah.
That's gone.
Yeah.
But, but going back to single families, if you have a landscaper, let's say, that's helping and, their costs, they're getting clobbered, so you're going to start to see these small $50 a month here, $50 a month there. And then if you need a new roof or something like that, or a new AC goes out, didn't you have one of those just happen?
Yep.
Yeah. So that was $4,000 or $5,000, right?
Yeah.
So, those are the that's what I'm talking about for reserves. So if you have reserves when normal things happen, or let's say a tenant moves out and you have to put a new floor in or whatever it is, that's what you want to build that up first and then just distribute. Once you have the reserves where you want, you don't have to worry about how much, is the right number.
Right. And, even with our handyman, handyman prices, in 2019 was $40.
Now it's $75.
Now it's
right?
$75,
and that's just a few years ago.
Mm-hmm.
Yep,
doubled.
Same people.
Yeah, same people, and there's less of a demand, so there's also a 2-hour minimum, and less of a supply of handymen. So there's 2-hour minimums and all that stuff, right? So that really eats away at your cost as well.
Yeah, because you ask them and they say, well, everything, my workers' comp has gone up. My insurances have gone up. Mm-hmm. The fuel for my car has gone up. Now we have one guy, we have a trip charge now.
Yeah.
Right? Like, well, where'd that come from?
Mm-hmm.
So these guys are getting killed too.
Yep.
And they're just building it into their per hour rate. You can't blame them.
No.
They're not in the business to lose money. But that's all rippling through.
I think interesting too is I've talked to more and more landlords and more tenants that have that are renting, and they're saying that their landlord is having them sign addendums where they're responsible for the first $100 of every repair and all that, because these repair costs are killing landlords. So that's becoming very common, and something you might want to think about if you own rentals.
That's a good point.
Is passing on some of that cost just in, it has to be in the lease, obviously, but basically any repair, they're responsible for the first X amount of the repair. It cuts back on the calls, right? But it also helps you with the cost.
Yeah, it's a good point. Yeah, especially if you have something that's needs a lot of maintenance.
Yeah. Absolutely. Or you have, picky tenants.
It's true too.
They're getting more picky. So I thought this was an interesting question from Rateb. He or she just asked it. He said, "Yo, Ken," a lot of energy there.
I love it.
"I'm looking at a property that seems like it might be undervalued. How do I go about finding the value of the property if there aren't many sold in the same area to compare?"
So it's hard to know what kind of property it is, but I'm at that price point. Maybe it looks like it might be commercial.
Multifamily, maybe.
I don't know. Obviously, if it's single family, it's pretty easy. Sold comps, and by square foot prices. If it's an office building or maybe a warehouse or something like that, might be a little harder. But you just got to engage the local people in the area. But most of the time, the best way to do it is, did he say undervalued by 5 or 8?
Yep.
Okay, wow. So it's even more. So it's going to be based on cash flow, period. So what does that mean? It means your net operating income divided by the capitalization rate. That's the value. And, also, you might be right on this. Once you put a tenant in there, raise the rents or whatever. I bought an office building this way where the rents were, super low, and we basically doubled them in about 3 or 4 years. I'm actually in escrow on that building right now, on an office building where I think we bought it for in the mid 3s, and we're in escrow for somewhere in the mid 9s right now, and it'll close next month. So you can do this all day long, but in that particular case, it was based on the income that was coming in minus the expenses, so the NOI. So that's typically how properties are valued, but it's hard to know without having a little more detail.
Yep, and he said it's a fourplex, so.
Okay. So that seems like a lot for a fourplex, but you would know better than me. That's only 4 units, obviously, so 500 to 800. That means that each unit is undervalued by up to 200 each. But again, if they're $1 million to $2 million units, that means they're 20% off a market. But if they're $200,000 units, I don't know if that, it sounds a little skinny.
Yep. Well, thanks everybody for joining us today. We will see you next week. Hit the like button. We're only 19 likes away from where I wanted to be.
All right, guys. We'll see you.